The root dynamic here is called disintermediation by Bookstaber. The time frame for being able to do transactions in the futures market was substantially different from the time frame in the equity market, yet these two markets had both been linked together through market arbitrageurs. A precipitous drop should have traders licking their chops, but it doesn't work that way. If prices drop too far and too fast, it sends the wrong signal. Rather than taking the drop as an indication of liquidity demand, they wondered if it could be the result of some new market information. In the last 75 minutes of trading on October 19th, the Dow dropped over 300 points, 3 times as much in a little over an hour as it had in any other full trading day in history. I was standing watching the ticker tape at the local Merrill Lynch office that afternoon myself, and it was an awesome sight to see. At the root of the crash was computer-assisted liquidity via rapid program cash futures execution and an innovative product, portfolio insurance, which demands liquidity for successful implementation. The market was developed to allow lightning-fast reactions while at the same time driving complex innovations in market instruments and strategies that required ever more time for investors to analyze and absorb. This combination of speed and complexity would be the source of many future crises. Therefore, in late 1987, the Plunge Protection Team was formed, consisting of the chairman of the Federal Reserve Board, the Secretary of Treasury, and various other members who would work together to avoid another crash starting before the market opened with the derivatives in Chicago. Now, there's another area in finance called investment banking. It was a backwater in the 1970s. It used to be involved with mergers and acquisitions. It was a slow, sleepy job involved when mergers were taking place. Then came investment banking regarding treasuries. Then came investment banking involving fixed income. Then mortgages. Then swaps and derivatives. Then emerging market debt. This pressure. What happened was that once any one of the things I've just mentioned became standard procedure, and there were a large number of them, it became stale, and the money that you could make off it for a particular bank went down. So you wanted to come up with a new product that was new and interesting and would get you more people involved. So the treasuries, the fixed income, the mortgages, the swaps and derivatives, and the emerging market debt came out as soon as they could be engineered and pass a number of iterations in a computer program rather than being fully road tested. Fall of 1993, Metallgesellschaft Refining and Marketing's U.S. subsidiary of a German company closed after the American subsidiary offer to oil companies at a fixed price for 10 years collapsed. There was an American subsidiary of a German company that promised its customers fixed oil prices for 10 years. And they thought they could do it, and they thought they could deliver this, and they thought they could make money off it. They could not. Oil prices dropped in the fall of 1993, and the German parent closed out its position for a $1 billion loss. That's an example of futures that busted the entire organization. In 1994, Orange County, California went broke after its treasurer, Robert Citron, through Merrill Lynch, bet that medium-term interest rates would continue the spread, differentiating them from short-term rates. In other words, your short-term rates are a certain interest rate, your medium-term rates are a certain different rate, and that the spread would be fairly constant. This was Orange County, California, and its finance officer. The county filed for bankruptcy and reached a $400 million settlement with Merrill Lynch. They claimed they were misinformed by Merrill Lynch, and Merrill Lynch had to pay. 1995, Bankers Trust, which had become a leader in marketing derivatives, was sued by Procter & Gamble, Gibson Greetings, Federal Paper Board, and Air Products, who won $200 million in damages. Back in 1992, Nick Leeson of Barings Bank in Singapore made a volume mistake in a trade, which he covered by larger and larger bad trading of derivatives. By February 1995, the entire Barings Bank, the oldest of Britain's merchant banks, went broke because of a $1 billion in unauthorized trading, and it was sold for £1 to ING and disappeared. So when you mishandle these kind of complex future instruments, the entire organization can go down. We knew this in the mid-90s. And additionally, Joe Jett created phantom transactions and treasury strips for Kidder Peabody that in 3 years created a $300 million loss and destroyed the prestigious company. Now, the following is going to sound very arcane and very boring and irrelevant, but it's short, and I want you to remember it because I'm going to come back to this at the very end of my presentation. In the mid-1990s, this is from Bookstaber's book, in the mid-1990s, an extremely condensed computer language, APL, came out of Harvard, invented by Ken Iverson. Follow-on versions of APL were even more condensed. It got so that it was nearly impossible to review such programming except by running known test data. I'm going to say that again. It got so that it was nearly impossible to review such programming except by running known test data. Derivative and swap pricing problems landed on the weakest point of APL. Bookstaber himself worked with the new APL crew, posing the problem in different ways. They would try to struggle the problem in matrix form, but there was not enough memory to hold a matrix of high enough dimensionality to solve the problems with an acceptable level of precision. These problems were a headache for me and never really did get resolved before I left Morgan Stanley the following year. All right. Why would you use a highly condensed language like APL in order to do simulations for your transactions and for your instruments rather than a simpler language that someone can just read the code and determine whether it's correct or not? And the answer to that is that the safety in these tests is in running thousands upon thousands of iterations and seeing what the pattern is. If the computer is reading code, line after line after line of code, it is spending a lot of time listening to instructions rather than running an iteration. And you can run more, the more compact your code is, the more iterations can be run. And the value was placed in the number of iterations rather than the accuracy of the program. This will be very important when we get to my conclusion. UBS made risk management errors on its computers and got absorbed by Swiss Bank Corporation in 1998. By the late 90s, every investment bank had a cadre of risk managers, a flow of daily risk reports, and an organizational structure that included high-level risk management committees. The types of risk that could be readily measured were better controlled, but those were not the risks that mattered. The real risk is the one you don't see. In April 1998, Commodities Futures Trading Commission Chair Brooksley E. Bourne meets with Greenspan, Rubin, and Levitt and loses the fight to have all derivatives conform to CFTC requirements. This was described in some detail in the Washington Post in its article about what went wrong with our economy on October 15, 2008. It was a front page story. What happened is that Brooksley Bourne said all of these transactions and all these instruments really belong within the trading matrix of the Commodity Futures Trading Commission and should have reserves, should have agents, and should be subject to review and discipline as required. Greenspan said no. Rubin and Levitt didn't like it. They fought over this. And later in the year, it was decided to continue studying it and not do anything about it. On May 7th, 1998, the Commodities Futures Trading Commission issues a concept release about the derivatives and their risk, which was not acted on. On July 5th, 1998, Solomon Brothers Arbitrage Unit announced it was disbanding. Now, Bookstaber goes to some detail in his book explaining that you can't just disband your arbitrage unit and sell all of these instruments on the market in one day. It takes months for them to unwind, or you lose all your money.